Hello, it's Rhonda Thomas, and we're going to finish Personal Finance Exam 1 Review Part 2. So this is going to be problems 12 through 22. All right, so I'm going to share my screen and the sound, just in case that helps. Okay, so here we are on number 12, and we're ready for the spreadsheet. So this is a number or a chapter 4 problem. So I'm going to go get that in Excel, and this is looking to see, what does this one read? This one says, will Anne and Carl receive a refund or owe additional taxes? Okay, so it's actually coming up with the amount of taxes that they will owe. Okay. And they do have a tax credit. All right, so I think I've got it here. Let me bring this in. Okay. All right, so this is actually number 12 for us. Okay, so here are a couple things that you'll want to put in. All right, so we need the AGI to start with. Now, they didn't have to find the gross income. You've been given the AGI, which means that there's been some adjustments already against their gross income. Okay, so now the standard deduction, which we don't get anything different, so there's not anyone to choose, and it looks like their marginal tax rate is 10%. They're in the 10% tax rate or bracket, whichever way you want to put it at. Okay, so let me put this in. Okay, so let's put this amount in here. So here comes our taxable income. Okay, and the taxes that are owed is 10% of that taxable income. That's what that is. Then the income taxes withheld is $2,060. So they have an individual additional taxes owed of $554, but they have a child care tax credit. It comes out after you figure if there are any additional taxes owed. And it turns out, if I've calculated this right, that they not only don't have additional taxes, they have a refund coming. Okay, so just remember, a child tax credit or any tax credit for federal income tax is subtracted as the last thing when you're actually seeing how much of a tax liability you have. And once again, you know, your employer, or if you are if you're self-employed, you're supposed to pay that in. All right. So what I've got for my answer is a refund, and I've got $446. Okay, so just got to remember that credit comes on the last, and it looks right. And this is for if you had a child, right? If you had a child, then that would be helpful, right? That would be helpful. Let's go to number 13. Okay. Number 13. Okay. And let me highlight my answer. Some of these I know I have forgotten to do that. All right. So this one says made 2 investments. The first was a 14-month and the second was a 2-month. This is called capital gains. Okay. Let me just finish reading it. So Sam made 2 investments. The first was 14 months ago, which is considered a long-term capital gain. And a second was just 2 months ago, which is considered a short-term capital gain. He sold both of those investments. Both of those investments brought in $12,500 of a capital gain. If Samuel is single and has taxable income of $41,500, what will be the amount of capital gains tax on each investment? Okay, so this is the two capital gains investments. I've got to go to chapter 4. So one moment, please. It turns out that capital gains, here it is. Long-term capital gains. Okay. Long-term capital gains. All right, let's put this side by side. So we've got a long-term capital gain that we've held for 14 months. Long-term is considered anything more than a year. Short-term is anything less than a year. Okay, this is a single person with 41,500. Yeah, 41,500 in taxable income. Okay, taxable income. So first thing I'm going to do is finish this, and then we'll go look at the tables. We have to use both of these tables. So usually, okay, both of these have a capital gain of 12,500, 12,500. 14 month, held on to 14 month, held on to 2 month. Okay, it says, what will be the amount of the capital gains tax on each investment? Let's go look up taxable income rate. Okay, what is his normal taxable income rate? He is a single taxpayer. He makes $41,050. That falls into the second tax bracket. So that's going to be 12%, second tax bracket. Okay, second tax bracket. It's good to know which one it is. And you got to make sure you look under single. All right, so then we don't need that one anymore. Now let's look up the capital gains table. Capital gains table. If you're single, which he is, and his amount of income falls on the second line, yep, that's 15%. I don't think you get too much of a break anymore with this. This used to be a big deal. Okay, so there's 3 brackets when you're talking capital gains, right? So he makes just a little bit more than this bracket. So he's going to find himself in the 15% bracket, and that's what I have right here. So this is 0.15, and I've got to change that to a decimal. So hang on. Okay, there's the rate. Okay, there's the rate. And okay, his rate over here is 12%. Okay, so the taxes, I went ahead and put 12% of that. So he's going to owe $1,500 on this one and $1,875. So there was a time that you would have a preferred special tax rate. But notice capital gains tax rate doesn't really help anybody in the 12% tax bracket. What it helps is people that get into the 33% tax bracket, the 35% tax bracket, right? If I open up that taxable income rate, look at the tax brackets, right? So the most you have to pay taxes on a capital gain long-term is 20%. So it really does not help anybody. Well, it might. Sorry, it just depends on that breakdown and what filing status you are. But it definitely helps those in the 22, 24, 32, 35, 37 tax bracket, because the most you'd pay on capital gains no matter how much you make, is 20%. Okay, so this is what they call a tax for the rich. Yep. And that's okay. That's getting them to invest, I guess. So, all right. So let's see what the capital tax gain, the capital gains tax, how much would we have to pay for the 14-month one? I got 1875 at 15% of the gain. The other one is 12% of the gain, which is 1,500. And if you want to see the difference, it's $375. So they didn't ask for that, but I'm giving you more than you probably want. Okay, we're going to number 14 now. This is a payday loan. I think we're crossing over into chapter 5. Okay, so let me go get chapter 5, I think. Let me see if this is the one I want. Okay, hang on just a minute. I got quite a few open. Nope, that's 7. Hang on. That is 4, 1 through 4. There it is. There it is. Okay, so chapter 5, we're looking at a payday loan. Okay, payday loans are usually got a pretty high interest rate, and they prey upon people that are in dire straits with their money. Okay, so that's just part of the industry that they're in, I guess is a way to say it. So let me copy this. This is number 14. Okay, we're going to try to pick up the pace just a little bit. Number 14, a payday loan. Okay, let me put this on here. I got to go back and get it. Hang on. Payday loan. Here it is. Copy. Bring it in. And here we go. Payday loans. This one it charges 6.25% every 2 weeks. So I told you that interest rates are always stated annually. Well, this one is not. Okay, so you would really need to make sure that you read the contract. And this is happening every 2 weeks. So what is the annual interest rate? So we're going to annualize this 6.25% rate that's happening every 2 weeks. Well, if you look at, there's 52 weeks in a year, divided by 2 is 26. Then we're going to take 6.25 times 26, and you get 163%. Oh my goodness. So this is what it should read. Okay, no, that should be the right answer. And here's how it would work. Let's just say you borrowed $100. If you paid it back on time, like you should, you would owe $106.25. So that's not too bad to pay a little interest on. But if you left that $100 to be paid and it took you more than a year, then you would owe, let me get this on here, interest of quite a bit more than you did that you borrowed the money on. So you would owe $163 in interest on a loan that you took out of $100. Woo. All right, so just so you have an idea, I know they only wanted the percentage for this answer. That's a big amount. I think there's been some rule changes in the law for these kinds of loans, which there definitely should be. So they should not be making that kind of money on people that are in dire straits with money in there. Anyway, all right, sometimes they're also called car title loans. You can put your car up as collateral for a loan. So have to be careful with those too, or you'll lose your car and there's no way to get to work. All right, what amount would you have if you deposited? So this is a time value of money problem. What amount would you have if you deposited $3,500 each year? That's what it should say, each year, for 40 years at 8%. This is a future value of an annuity. So anytime you're looking at how much a retirement account would have in it, that is a future value usually of an annuity. Just depends on whether it's same amount each time or just one amount. All right, so let's put this in here. And so once again, this is the future value of an annuity. They found an account that pays 8%, and they've got that long period of time for 40 years. Wow. Okay, they're putting in $3,500 a year, right? Which if you took that times the 40 years, just in a regular bank account, just in a checking account, or if you didn't believe in the banking system and you were too afraid to put the money in, then you would have $140,000. But now let's see how much the time value of money will help you grow. Okay, and once again, this is table B with an 8% for 40 years. Okay, I think this is my favorite figure to do in time value of money. Okay, once again, I got to go find a factor. And this is table B. We're making 8% for 40 years. So 259,057. 259,057. Wow, almost $1 million. Let's see what the calculator says to see if it seems correct. So once again, the payments each year, $3,500. We're looking for the future value, 8%, 40 years. Make sure you change this to annually or it won't work right. So we got 906, 697, 82. Looks right. Looks very close to what we found in our table. So let's put that in. So she's almost a millionaire. Yours might show that it is. I'm going to put what I got from the table because I'm still double checking Connect to see if you should be able to put anything in from the table. Yep, there it is. Okay, moving to the next one, number 16. Okay, number 16. Based on the following information, determine the true balance in your checking account. All right, this is balancing a checkbook. I believe this comes from chapter 5. I think it's the last problem we did in chapter 5. Here it is. Okay, here it is. We will put this in the spreadsheet. Oh, okay, I must have not kept it. Hang on a minute. Go back and get it. There it is. Copy. Bring it back up. That's not the one I want. There it is. Okay. We're ready to put balancing a checkbook in here. Balancing a checkbook. Let me make that one. All right. So balancing a checkbook doesn't happen a whole lot anymore because we all have online banking, most of us. We try to go in and check our balance. Hopefully you go in and check your balance at least every other day. But here's how we used to have to do it. I wasn't ever too excited about doing this, but the idea is that what the bank says you have in a bank account and what you show that you have, like from keeping a checkbook register, might be different. The reason why they probably are different could be timing. Timing is not so different today with all our online stuff, our electronic funds transfers and our direct deposits and all that. But timing and errors tend to be the reason for the difference. So I'm going to put down what the balance says from the bank on the left side. I always do that. I always put the bank on the left and our checkbook on the right. So here is what mine says. So you got a checkbook balance and you got a bank statement balance. And then you have 4 items. Those items are going to be used as adjustments. We need to adjust each side based on these items. And here's how I help make sense of which adjustment goes where. First of all, the difference in the 2 checkbook balances is $179. Okay. The service charge, if you look at a service charge, who knows about the service charge first? The bank does. And I say, here's what I say. The bank side or the checkbook side, the adjustment goes to the side that did not know about it first, did not know about it first, did not know about the item. I'm going to put the item first, okay? Errors, if you have any errors, which we don't in this problem, then whichever side made the error gets the adjustment. Adjustments in this case are either going to be additions or subtractions. So the first one is the service charge. Who knew about the service charge? The bank did. They're the ones that are charging us that. So we need to subtract that from our balance. How about the interest earned, right? The interest earned is $6. So I'm going to put that amount in. The bank knew about the $6 interest. We need to add it to our checkbook. The second one is the total of the outstanding checks. Outstanding checks are checks that we wrote from the checkbook that have not cleared the bank yet. So we want to subtract the outstanding checks. And just like outstanding checks, there could be some deposits that we said made our checkbook go up, but the bank hasn't received yet. So for example, sometimes when you take a picture of a check and deposit it in your online banking, it takes a little bit. Sometimes the funds are not immediately available, right? They have to process. It's a lot faster than it used to be. It used to be that if you wrote a check to pay a bill, that company deposited your check into their account. That bank had to send it to the bank of the person that wrote the check to get the funds, okay? And then the person that wrote the check would get that check back in the monthly bank statement. We don't do that anymore. In fact, a lot of us don't even save receipts or check receipts to see if we've been charged something that we can't identify. So once again, if you can come up with a balance for both of these, there is the balance for mine. Okay, so give yours a whirl. I think we all have the same kinds of adjustments. It's a matter of putting it in and plussing and minusing it to get there. All right, we're ready for 17 now. This is the problem about going to chiropractic school. So let me go get this. I think this is chapter 6, if my memory serves. So let me go to 6. And this has to do with using a ratio, your debt to income ratio. Think could be, there it is. Debt to income ratio. So ratios are used to test your ability to handle credit. Yeah, if you've already got some, if you've never had any, that's a different story. This one is if you have some debt. All right, have some debt. So let me put this in our problem here. And we should be able, so debt to income ratio. What is the monthly gross income? I have 1610. Write it down. I have found that when you write this stuff down or put it in Excel spreadsheet, that if you make a mistake, it's much easier to fix it because you've put down all the information. Her employer deducts $211 from her check. So we need to make that happen. So she's taking home $13.99. Says she pays $101 on a credit card debts each month. The loan she needs to go to chiropractic school would cost $889. Help Kim make her decision by calculating her debt payments to income ratio with and without the college loan. And then we have that 20% rule from the book. The book suggests that when it comes to having debt payments, debt payments, that you shouldn't have any more than 20% of your net income or your take home. Now, this does not include your house payment, and I don't know I think there's a chance it doesn't include a car payment, because those loans have collateral behind them, which means there's an asset of value sitting there waiting in case the loan defaults. And if the loan defaults, then the bank gets the car or the bank gets the house. Yep. All right, let's put this in. Her credit card payments are $101. Yes. Okay. $101. Okay, and then the college loan is $189. Okay, I need to make her credit card payments equal 101. That makes her debt be 290. And then we're going to divide by her net income. So here is the ratio without the college loan. I think you should do that one first, even though that's the second one. So before taking on the college loan, she has 7.22% is her debt to income ratio. If she adds the loan to it, she's just a tad over the threshold, which the other thing they don't mention in this problem is they don't even talk about the potential of how much more money she could make once she's done with chiropractic school. And then I want to see what it looks like if she gets rid of her credit card debt. Maybe her parents could help her pay it off and she could pay them back later after she's out of chiropractic school. But doing a ratio this is the ratio with college loan paid off credit cards, right? I think they should have done one more, because that way, because if you're basing your decision on whether you're going to go to chiropractic school on whether it's 20% or higher, this is going to be a no. But right now, I think she's working in a shoe store and only making $13.99 a month or bringing it home. And I'm fairly certain that a chiropractor probably brings home more than that. All right, so there are the two that you got to put in, but I went ahead and did one just for good measure that would tell you how much it would be if she could eliminate the credit card debt. And so then she'd be under that 20% threshold. Okay, I think we're good. Let's see if I got it right. Hope so. Be careful, they want 2 decimal places there. Going to 18 now. All right, we're looking at disposable income from a part-time job. Okay, I believe this is going to be chapter 6. Disposable income from a part-time job. Here it is. Okay, and the fact that you have debt. Okay, the fact that you have debt, how much will be available for you to spend. Okay, so let me bring this in. Yeah, Okay, so. Okay, 2025 disposable income. I got to change it because the last time I did this, it was a different number. $16,800. Okay, I borrowed $1,200 in 2024 at 13%. So putting in my information at 12%. Okay, so there I've got to do some calculating differently now. Right, so this is going to be $1,200 times 13%. Ooh, 13%. I got to go fix that. 13% times 1 because we're paying it back in one payment for the year. So let me change this to 13. Okay, you've got to watch those numbers, boy. Okay, so now what we're going to do is take the loan, which is $1,200 times 13%. Times 1, that's $156, right? The loan is $1,200, so we actually will have to pay $1,356, right? $1,356. So I'm going to put this in, and I'm going to make it equal what we found here. And so when you take her disposable income and you subtract the loan and its interest that she has to pay back at the end of the year, the available amount she can use on spending, if she has no other obligations, is $15,444. Okay, so it just goes to show that borrowing money actually reduces your available spending in the future. But sometimes you don't have a choice. You've got to borrow some money for something, go to school, buy a house, buy a car. It's just kind of the way of our world now. All right, number 19. This is coming from chapter 6 as well. Another ratio. This is called the loan payments to income ratio. This is looking at Carl's house payment is $1,290. So let me go get this from chapter 6. Okay, so I'm going to borrow this and bring it in. Okay, Carl's monthly house payment is how much? I'm going to put that house payment right here, $1,290. He has an automobile payment of $399 a month. So his total loan payments. Now this doesn't include any credit cards or any educational loan payments or anything. So we also need to put down his take-home pay. I've got $1,290 as my take-home pay. Okay, whoop, wrong. $1,290 is my house payment. All right, $3,520 is the take-home pay. This is the numerator. This is the denominator. So this is going to look like this, right? So here's my payments. Here is my take-home. Okay, so once again, this is the numerator and the denominator. Numerator. Denominator. All right, so we're going to come up with a ratio that's a percentage. So equals the top number divided by the bottom number, and we're going to then turn it into a decimal. How many? Turn it into a percentage with 2 decimal places. So let's change it to a percentage, and we want 2 decimal places. So we're looking at 47.98%. So what this is saying is the amount he's paying out on loans, right? Even if there's collateral behind it, like a house or a car, he's paying out 47.98% of his take home. Okay, so there it is. And you say, is that good or is that bad? You'd have to look it up online. I can't remember what we look. Uh-oh, hold on. There's something wrong. Sorry about that. What did I do? Let me go back. Oh, the auto payment. No, hang on just a minute. Let me see what's happening here. All right. So, I transposed. Yep, there it is. 32.50. Boy, 32.50. Now, oh, that's a little worse. Yep, that's a little worse. I'm going to go back to the problem. You can you can check your work as much as you want in these. Okay, and you can use this again if you want to practice for the test. That's up to you. There we go. Not that much different, but still different. Okay, you got to put in the right information. What is it? Garbage in, garbage out. Okay, next one, number 20. We're almost just a couple more and we'll be done. Okay, number 20. This one is took that cash advance. So now we're crossing over into chapter 7. So I'm going to borrow my chapter 7 tab here. And we're looking at a cash advance. So cash advance. Here it is. Here it is. So we'll copy all of this and bring it in. Helps us to understand what we're doing. And I'll go here and put this in. All right, so we're getting a $300 cash advance. Her credit card charges a 3% cash advance fee right off the bat. Okay, so you might make this your last opportunity because that way you don't owe so much. But you know, sometimes you just got to do it. And just like sometimes when you get to an ATM machine, you're going to be charged that service charge, but you got to have the cash. So it is what it is. All right. So the first one's $9. Okay, let's go through this. Now we're going to take, so $9 is the cash advance fee. Now we want to figure out what the interest will be for 1 month. Okay, of carrying, she didn't carry the balance. The thing is, the interest, there is no grace period. Let me finish reading this. The bank charges 3% cash advance fee on the amount borrowed and offers no grace period on cash advances. Well, you could see my lights went out like I have nobody in here. That's funny. All right, so the interest does not have a grace period when you take out cash because it's more of a risk. You're taking out cash, you're not actually buying something with it. So that's their justification of charging you more interest. So we're going to take the $300 and our credit card is 16%. So you got to find it down here. Yeah. So 16%. We're going to put that in our calculation and it's for 1 month. Leave your interest rate alone. Change the time. 1 month is 1/12. Okay, that's going to be, I got to turn this to 16 and my amount that I borrowed to 300. Maybe she had to have a tire fixed. And all they would take is cash. I don't know. Some places don't take credit cards because it costs more to process a credit card for a business. Did you know that? Yep, every credit card, every debit card that they use to run a payment costs them money, in a fee, a processing fee. So if you ever are working with someone that takes a different amount if you're paying in cash versus the amount that you would use your debit card on, see if you can go get the cash for it. Okay, see if you can go get the cash for it because then you're going to save a little money I would not be surprised, especially with all the tariffs that are being added on. I would not blame a store for putting the tariff on the receipt, number one. And number two, I would not blame a store for assessing a credit card processing fee on your receipt, because the fee is based on the amount of the sale. So the more you buy from them, the larger the fee is going to be. So the total amount that we have to pay back, right, is she had $9 just to get the cash. She had something's wrong here. Just a minute. Let me see what my calculation is. Oh, yeah, no wonder. Sorry about that. There we go. $4. $4. There we go. The interest for the month. So we have both the fee and interest. And when you add the fee and the interest together, this actually comes to what they call a finance charge. So this is based on the $300 cash advance. Okay, together these are called the finance charge. Together called finance charge. Okay, so we'll see that the cash advance was $300. So she's going to owe total $313 to pay that back. And that's not even paying it with interest. Well, it's just 1 month's worth of interest. Okay, 1 month's worth of interest. But once again, she doesn't get a grace period. Most credit cards give you a grace period. Okay, and so I put that wrong amount in and I didn't fix it. So, but they don't, this particular one didn't give a grace period when it was cash that was taken out of it instead of using it to pay for an item. Okay, it's just their justification for charging you more. All right. Number 21. Okay, this has to do with automobiles. Oh, by the way, let me finish this one. So here's how much you really paid. So you paid $13 to borrow $300 in cash, right? So it turns out that the cash advance on that $300 is about 4%, okay, of what you, yeah. So you're paying 4% on your $300. Okay, so, okay, let me put this in again. I messed it up. $9 and, no, this is the auto. Yep, I just about did it again. All right, copy. Let's bring 21 in. Nope, just a minute. $21. Okay, this will be from chapter 7, which we did quite a bit more. Oh, this is on my other tab. We did quite a bit more credit things here. All right, here's the one we want. It's kind of a big one, but it's okay. We got to use that APR. Oop. Okay. Why not? Copy. What's it fussing about here? Okay, let's try this. Okay, so now I'm going to bring that onto here. And then I'll fill in the information. All right, this is how I would do it. Okay, after visiting several automobile dealerships, Richard selects the used car he wants. He likes its $11,800 price. Okay, but financing through the dealership is no bargain. He has a $2,000 down payment, which means he's going to need a loan for $9,800. So when you take the price of the car and subtract the down payment, cash down payment, there's the $9,800. It looks like this is, okay, so in shopping at several banks for an installment loan, he learns that interest on most automobile loans is quoted or basically calculated at add-on rates. That is during the life of the loan, interest is paid on the full amount borrowed, even though a portion of the principal's been paid back. So if you look at a simple loan and you're making payments on a monthly basis, every time you pay down a little on the principal, you're paying that much less in interest. Well, these kind of loans don't do that, okay? And this is a 4-year loan, and mine is 13% this time. So one more time, this is an add-on loan. Interest calculated and paid on the full amount of the loan borrowed, even though a portion of the principal has been paid back as you go, right? As you start paying down on your loan, on your car over 4 years, you shouldn't have to pay interest on the full amount. You should only pay interest on the amount of the loan, the amount of the principal that is gone unpaid. Much more interest paid on the dealership add-on loan. Regular loans charge interest on the balance of the principal. Balance of the principal. Principal of the loan is the actual loan itself, the amount. Okay, so let me go ahead on the principal loan. Okay, so what we need to figure out is what is the total interest on Richard's loan? Okay, the total interest, the loan is $9,800 times 13%. Okay, so let me put this in, $9,800 times 13% times 4 years. Okay, 13% times 4 years. That is the answer we're going to get for the amount of total interest. He's going to be charged 13% 4 years in a row on the whole amount of $9,800. Yep. So 9,800 times 0.13 times 4. All right. So total interest is $5,096. What's the total cost of the car? Now be careful. We got to go back to the price, not the loan, the price plus the interest, which is right here. So now that vehicle, woo, is $16,896. When, wow, that's that much added to the car price. So let's put that number in, $16,896. Now, what's the monthly payment? Got to go back to the loan. Be careful. Back to the loan, the $9,800 plus the interest. And then we're going to divide that by 48 months. Remember, 4 years times 12 is 48 months, and he's going to be making a monthly payment. The monthly payment is $310.33. This last one is using that big APR formula, right? Let's remember what it is. This is called the APR formula, and you only use it when you're making monthly payments, monthly. So this is the formula. The 2 is in there, and so is this 1. It's in the formula. So 2 times the number of payment periods in 1 year, so there are 12, times the total dollar cost of credit. Total dollar cost of credit is our $5,096. The principal of the loan times the total number of payments that he's going to be making, which is 48 plus 1. So here's what it starts to come down to. The numerator is 2 times 12, and I've got to replace that number there because it's now $5,096. All right, and then the loan is 9,800. All right, and then now I've got to do my math here so that the numerator is calculating correctly, but I wanted to show my work so you can see it, right? So then let me put 9,800 in with an equal sign. Okay, so it looks to me like, let me just double check my figures here. I got 2 times 12 times 5,096. Yes. My denominator is 9,800 times 49. Yep. So it looks like the annual percentage rate, because he's paying it monthly, because it's an add-on loan, add-on. It's a special kind of loan that gets a lot more money out of you than you realize it is, because he thought he was only paying 13%, right? No, it's calculating to 25.47. Let's just double check my numbers now, right? So make sure you follow along and get the pieces in there that you need. All right, last one. Okay, this is on chapter 7 as well. Okay, so we just went in order. And I'm going to put this, copy this and bring it down, and then go find that problem. This will be our last one for exam review 1. Hopefully this has been helpful. You are going to have your own set of numbers to do all these with so that you can determine if you're catching on or not. Okay, so this is Damien borrowing money for a television from his aunt. Okay, from his aunt. Okay, so let me find it. There it is. I even put the word aunt there so that I don't forget. Okay, so it's coming over to this last one. So the loan to buy the TV, $2,700. Okay, Damon has made a deal with her. This should say she has agreed to charge only 6% interest. Okay, so it looks like when you take, and that he's going to pay it back, and he has agreed to repay the loan at the end of 1 year. So we're going back to simple interest, simple. Okay, remember, if it goes into monthly payments, then it's a different calculation. Okay, so once again, $2,700 for a loan. The interest amount is what they want. They want the interest amount. They don't want the amount paid back. They want interest. So $162,000 or $162 is the amount of interest for 1 year. Okay, and it would look like this. Okay, it would look like this if you drew out the problem or calculation. It would be $2,700 is the loan times 6% times 1. I always put the 1 in there, even though I know it doesn't affect the calculation really. It's showing that the time is accounted for, because principal times interest times time is $162. So that's what we want. Okay, let me check it, make sure I'm right. Never know. All right, that's it. That's the end of the review. Please know that the exam is to be taken on your own. It is open resource. It is proctored by an online software proctor through Connect. Okay, and you have 90 minutes. Okay, you're going to get 35 multiple choice questions. That means 5 from the 7 chapters And then you're going to get one problem to do from each of the chapters. And those 7 problems will come from these 22 that I have put in this review. So if you know how to do these and you are ready, you can use your notes to help. Okay, notes to help. All right, so I am going to save this and say goodbye for now. Okay, so let me stop my share and we'll call it good. All right, keep up the hard work. We are 1/3 done with our personal finance. Have a good one. See you next.